I look at price and I find it hard to buy things. And incidentally, professional investors aren't going to do better than the amateur in almost all cases. But I don't find things easily. I mean, we were on in March of 2009 when the Dow was in the 660s or 670s, and we talked about it then. I mean, it was the bargain counter, and it continued for a long time. Stocks have been very, very cheap, but you have to measure them against alternatives. I mean, if government bonds got to 15% like they were in 1982, that's a different equation against stocks than exists now.
You've had periods in the past, though, where you have said stocks look expensive to you, or that we look like we're in bubble-type territory. This is not one of those times, I take it?
This is not one of those times. Now, if government bonds go to 7 or 8%, which means if you own a long bond now, you get killed, the stock you bought now will not necessarily look attractive. It probably won't be attractive. I mean, interest rates are like gravity. If interest rates are 1%, and they're going to be that for 100 years, obviously anything that yields you 2 or 3% is going to do way better. But I don't think they're going to be 1% for 100 years.
Just to get into the nuances again, though,
yeah.
You're talking broadly about issues in terms of how you see the stock market as a great place for average investors, maybe a place where you're not finding all that many bargains. And when you look to buy a company all in, I mean, I've spoken with some people here this weekend who know an awful lot about M&A, who know a lot about private businesses, what they're valued at different things, who say that when they're looking at prices, things look really rich. You're talking about prices that are 15 to 20% above what's a fair price as they see it. Is that match up with what you see right now?
I would agree with that. That's why we haven't bought any businesses for quite a while. In addition to the normal factors in the public market, when people buy businesses these days, frequently they're being bought by people that are borrowing 60 or 70% of the money, maybe even more.
You're talking about private equity?
Mostly private equity, but not exclusively private equity. And we're not willing to calculate our returns based on borrowing money at 70% of the purchase price. That may be the best thing to do, but we calculate things generally on an all equity basis, and we are not competitive. And then you've got a general euphoria that, to some degree, the private equity funds have to put the money out, and it's kind of interesting what they do because they take the money which they get usually from institutional investors, and then they buy a company in the market from some of those same institutional investors, except pay a premium, and they say we can run it better if it's private. Then they hold it for a while, and then they sell it back to the market, and these private institutional investors, having paid substantial fees during the meantime, and say it's better to be public. I mean, it's an interesting exercise.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.